I just want to welcome Simon Dixon onto the show. Simon Dixon is a Bitcoin OG, been there from the start, and knows the market really well, has been studying it, been a part of it for a very long time. And so he's a good friend of mine. And he's always on our spaces, speaking about the geopolitics, speaking about finance, speaking about Bitcoin. Simon, the war with Iran is in its day number 10 now. Day number 10. We thought some thought it would only be a short war. It would be only a few days. It's now gone on for 10 days. But what Iran did was they immediately shut the Strait of Hormuz. Many thought it wouldn't last this long. It's already shut. Explain to the audience exactly what's happened in terms of from the financial market, oil industry, gas industry, in terms of by closing the Strait of Hormuz.
Yeah, sure. Hey, Sully. Hey, everybody. So, look, let's put this in context. This is the biggest oil supply shock of our lifetime, certainly our lifetime. Just to put it in context, the Strait of Hormuz, which is mainly a narrow choke point that is controlled by Iran, but also has an element of Omani part that it controls. But by closing it, we've shut the world off from approximately 20 million barrels per day. Just to put that in context, if you look at all the different supply shocks of our lifetime, the Iranian Revolution, 1973, that was only 5.5 million barrels per day. This is 20 million barrels per day. If you look at the Yom Kippur War, 1973, that was 4.5 million barrels per day. If you look at Iraq Kuwait in 1990, 4.3 million barrels per day. Iran-Iraq 1980, that's 4 million barrels per day. And if you look at Russia-Ukraine as well, which is more recent to many of us, 2022, that was only 2 million barrels per day. So this is 10x the impact of what happened during Russia-Ukraine. So immediately upon the news of the Hormuz being shut, we had a big spike in oil, but not uncharted territory. We had a bigger impact in Russia-Ukraine, even though this was 10 times the amount that's constricted, and a lot more as well. With Russia-Ukraine, it was like wheat and bread and really impactful. But this one is 5 times all of the crisis or supply shocks that I just said combined. So we had this 1 week where the market was trying to figure out what it means. So it happened over the weekend last weekend. And then this weekend, we had the futures markets really kicking in, leading to the opening today. We went to a peak of about $115 per barrel. And then immediately we had an announcement or an article, at least from the Financial Times, that pushed the price down to $100. And we're just teetering around $100. We've gone above, we've gone below. What was the article? The article was, firstly, it's a Financial Times, which is pretty much a mouthpiece for financial services companies. It was really, it was the G7, the top 7 economies in the Western world. They said they're going to release 400 million barrels of oil in order to try and control the price. This is coming from the G7 countries' strategic reserves. This includes the US, this includes, UK, Japan, these types of top 7 Western economies. So to give you an idea of what that actually means, currently the global demand for oil runs at about 104.9 barrels per day. So 104 million, barrels per day. That's the global demand around the whole world if we were functioning as normal. So if you take out, if they're going to release 400 million barrels, assuming that the supply chains work and everything else, then effectively this announcement, which took the price from $115 per barrel to around 100, this is just 3.8 days of global demand. And so this, if you look at, the 20 million barrels per day that's being removed, you could expect that we've got about 20 to 27 days of relief as a result of this. So they're preparing for a maximum of about 30 days. if you look at everything functioning well. So that's like to give you an idea of the extent of it. So this is more significant than anything we've seen before. I think the next one to think about, as we've been looking at this all week, is who's benefiting from this. And immediately, I think the main beneficiary is actually Russia and US relative to the rest of the world. It's all about relative because everyone's impacted by this. But Russia is the only country in the world that has the most amount of flows with their liquefied natural gas, and they can get it to places in crisis, in emergency, better than anyone else can in the world. So currently, what are they doing? Well, they're not sending it to Europe because obviously the Russia-Ukraine situation, the sanctions situation, and that. So what are they doing with the LNG and all the emergency routes and everything right now? They're sending it to Asia, mainly India and China. So China is able to, pay higher prices because there's also, negotiation points. But Russia is using this opportunity to basically hedge away from anyone that's dependent upon the Middle East, which many of the Asian countries are. And they're bringing a new dependency until this opens with the Asian countries. So that's the main thing. In terms of like the Asian countries, how prepared were they? India, if they don't resolve this immediately, and immediately we have started to see some new action with both oil and LNG between Russia and India. And if you remember to this, there was a big trade war back and forth between India and America. They reduced their dependency upon Russia, but now that's going to go back up again. So India basically have 1 month of reserves. Thailand and Vietnam have approximately 2 months of reserves, and it's estimated that China has about 3 months reserve in order to figure out an alternative plan, assuming that the Middle East couldn't do this. So that's really the thing. Now, China obviously is hugely impacted, but was prepared for this. But China also has its own ability to shut down everything. So if America's strategy was to cut off China, then China could retaliate by just saying, right, we're removing all exports, removing all rare earth minerals. They could shut down all markets. The American military could no longer function. They couldn't replenish any of their supplies. So the reality of the US doing this in order to choke off China is not reflective of that reality. So what is the US doing? So Russia's been a huge net beneficiary. They can resolve many of the issues that they were having in this wartime economy they've been in. But the US market, they basically use this opportunity to renegotiate with the European Union that is 1,000% hook, line, and sinkered. They have no choice. They either go to Russia or they go to America. And they have very low reserves right now, and the price is going through the roof. So America can just write their terms, and effectively what's happened here is that Asia has been vassalized deeper into Russia, and Europe has been deeper vassalized into America. And those are the two net beneficiaries of this situation. What that actually means is that there was leading up to this, the dollar was weakening. That had been a long-term trend relative to gold, relative to foreign currencies, relative to silver and other commodities. But ever since the war started, the US dollar has strengthened. And so that is because other countries are weaker. So you would imagine once this war ends, once we get a resolution, you would have new relationships that are very hard to undo. You would imagine what US and Russia will be doing is they'll try and lock them in for 20 years, and they'll use the fact that the strait is closed as an opportunity to say, right, we'll give you this price, we'll give you favorable terms, but you need to stick with us for like 10 years, 20 years, 30 years. So they're really both Russia and America are using this as an opportunity to kind of divide the world up and create those dependencies while the Middle East is stuck there in this war situation. Dollar is strengthening. That's been a reversal. So as soon as this gets resolved, you'd expect the dollar to start weakening again. But the only reason it's strengthening is not because, this is great for the American economy or anything. Obviously, LNG is great while these prices are up high. But it's because of relative strength. Basically, everywhere else is more affected than America and more affected than Russia. So stock markets are crashing to a greater degree, and their currencies are weakening to a greater degree. So we're about to have the markets open in US, and US is down, but outperforming all other markets. If I look at the futures right now, S&P 500, they're saying about down 0.2.3%. NASDAQ 100, 2.7%. That's a big move, a few $1 trillion. Dow Jones 2.5%. Crude futures were predicting 26.5% after the correction. Brent 23% up. Natural gas 9% up. And that's just oil. We can talk about some other things, but I'll take a little pause there. So just in summary, the net beneficiary winners of this is America using this opportunity while the strait is closed to renegotiate terms in Europe, and Russia renegotiating terms with Asia and being useful.
So with the US though, how much LNG do they have? In terms of what ability do they have to provide that LNG? Like, what's the scale they can do that at?
Well, they could do it to Europe at scale. So, and I mean, prior to this, it's been a strategic goal of America to become an LNG exporter. That was Trump's big policy that he wanted to push. So, America has a lot. They're energy independent. From fracking, they're oil independent during the Trump administration. But what happened is during the Russia-Ukraine war, America started draining its strategic petroleum reserves. They pushed out about 180 million. If you remember what happened, back then, the Houthis attacked Saudi Aramco before the war. So the Biden administration didn't really help Saudi. Saudi hated Biden because they didn't provide any defense, which obviously is what's really coming into these factors now as well. And so when the Russia-Ukraine war kicked off, the price of oil started going through the roof. That created an inflationary cycle. If you remember, everyone was queuing outside the gas stations in America. Biden went out to go and meet MBS, asked him to put a bunch of oil onto the market, and MBS decided to work with Putin instead. And that created that inflationary cycle. And then we had the big spike in interest rates. Those big spike in interest rates created some duration bond market issues at the banks, and we had the collapse of Silicon Valley Bank a little bit later as a knock-on effect. So that was what happened last time. In terms of America's reserves as an isolated economy and also vassalized with Europe, they'll be fine. But they're not going to be able to get their LNG out, to say India and stuff like that. Russia's perfectly suited for that. So it really breaks America and Europe into the Western hemisphere. And Russia, rather than working with Europe, it's going more eastwards.
So coming back to the point, right? I want to discuss each element of each country and what they're doing and how they're dealing with this issue. So let's take the US first. You're saying they're benefiting from the aspect of they're able to sell LNG, but the other prices the oil prices are still becoming more expensive for the average consumer. The goods are becoming expensive for the average consumer. So explain it in the perspective of, for an average American, what's the result of this? Not the oligarchs, not the corporations, but specifically the average American. What is the implications or impact on them?
Yeah, that's the exact right way to think about it. So the oligarchs, the wealthy, they're cashing in. They're getting Trump's negotiating new contracts for them. Defense companies are doing incredibly well. Oil companies are doing incredibly well. They're propping up the stock market while everything else is underperforming. The average American is going to have to pay a much higher price, and they don't have enough strategic petroleum reserves in America to impact the price. So if the Trump administration decides with that G7 announcement, if there's 400 million barrels and a chunk of that is coming from America, then the strategic petroleum reserve is going to be drained because I think they don't have enough to do that. That means that America loses the ability to control the price of oil and gas, which means that the corporate entities profiteer. You can get some price gouging. You could expect a similar thing to what we saw during the Russia-Ukraine war, that the average American will be trying to get prices locked in. If this continues, everything's on if this continues. And the average person is going to pay significantly more for their energy costs at a time when most people can't afford it. And you drive the world into, kind of speculation around the second this ends, you'll get a massive correction in price. But people are speculating if this goes on for longer, the price of oil will just, will keep going up. It seems like we've set like the price parameters for oil of around a peak of $115 and a low of below $100 while the strait is closed. But yeah, the average American costs go up. And if this goes and continues for longer, energy is involved in the production of everything. So you could expect if this went on for, say, 3 months, I saw some models out there that consumer price inflation could go from about 2.3% right now to about 3.7%. Is like the estimate. So in a nutshell, prices go up the longer this continues.
And just for the audience, that type of CPI change, what would that translate to? So, for example, something that costs $10 for goods would cost what?
13.7. Sorry, $10.37.
Okay. And coming back to what's happening, so things are going to become a lot more expensive in the US. Gas prices are going to go up. Goods prices are going to go up. Now, I want to bring this to Europe and the UK. I was reading before you came on that in the UK, they may only have enough gas for 2 days. I was also reading that Europe may have had similar issues. What's your understanding of the predicament in Europe and the UK, both from a country perspective and then from a consumer perspective?
Yeah, most countries in Europe and UK don't have high reserves. If you take the UK right now, it's currently it's suffering from low economic growth. Before this, the growth rate was about 1%. That's really dismal. We were having inflation was coming under control. But we were also having increased the way that the UK government was handling the crisis at the moment was to increase taxes. That led to a flood of millionaires and billionaires away from the UK around new windfall taxes. And interestingly, those windfall taxes were mainly around energy in the North Sea and Scotland. So prior to this, there was actually choking of the North Sea production via windfall taxes. So if you want to be a conspiracy theorist, there was anyone that controls these European politicians and UK politicians. In UK, they were strategically choking North Sea oil, which makes it dependent upon US. And then the only other option you have is Norway at that stage. So you've, they will have to frantically renegotiate, which means whatever terms Norway and America are offering, UK has to accept. There's no leverage. I'm not sure of the exact, reserves. They were looking at diversifying into expensive renewable energy, but that was a longer term thing and it never quite materialized. But they're going to have to, in the future, invest significant in infrastructure with China to try and create more energy dependency through renewables, which is significantly more expensive. So the only choice it has is America. Europe is owned by American corporate interest.
So they're going to have to make a deal with the United States of America. That being said, they are low in reserves. People are a bit concerned in the United Kingdom. Is the situation similar in Europe?
Across Europe, yeah, similar situations. Obviously, Germany was being choked because of Nord Stream pipeline. Europe, there has been a long-term operation from, this whole, ESG, to climate neutrality, to COVID, all the way through to, net zero, through to the Russia-Ukraine war, through to what we're witnessing right now to destroy the manufacturing base and the energy around Europe. So Europe is the net loser in the world,
Yeah.
as well as some of the regions in Asia.
And what about the people in Europe, the people in the United Kingdom? That's the reason a lot of people are joining the stream. They're concerned. They're worried.
Yeah.
Prices are going up, and the concern is they won't have access. The electricity and gas bills will go up. They don't want to have access to, maybe even they won't have access to fuel. Like, what's the situation going to be? How bad can this get?
This can get bad if the strait is still closed, but again, it is solvable. But you have to pay the price that America's going to want you to pay, and it's not just energy they negotiate; they negotiate everything else that comes with it. So, they will be able to solve the issue, but everyone's going to have to pay more. We're already seeing, some people are talking about they've been to the gas station and it's like double prices. That's what most people are telling me. So it's not an existential crisis like, some of the water issues in the Middle East. It is a pricing crisis. And last time, those that were right on the edge, we had pensioners choosing between eating and heating.
Exactly.
That's the same situation again, sadly.
Unfortunately.
I don't see any way other than there's going to be higher prices. And then at some stage, this will, if we close, if we reopen today, then in 2 months you could expect, things to have fallen out. But America's going to lock in these contracts and these higher prices. So I don't think Europe's going to be paying, lower prices for quite some time.
Okay. And then one other place before we go to the Middle East is the audience asked for it was Australia, and New Zealand. What's the situation there?
Yeah, Australia's, got their own supplies, and people have been looking at Australia to try and solve some of their issues, and some of the Africa as well. So everyone's going to be paying more, but they don't have any strategic weaknesses. They've worked on their own, commodities, rare earths, and energy as well. They're in a better position than Europe and UK.
Interesting. And now we go to the Middle East. The Middle East, we know that Qatar shut off their energy supplies to Europe. We're aware that Saudi Arabia, a number of the oil refineries have possibly been impacted and are taken out. What's the situation when it comes to energy and oil and the Middle East?
Yeah, so look, it's everything's moving towards kind of Saudi being the one that's able to help the Middle East the most. So if you're looking at a geopolitical trend, most of the GCC is effectively being vassalized into Saudi. Saudi had alternative pipelines and alternative routes. Now it's still caused stress. They can effectively benefit from these higher prices, but there's disruption here. So I think if you're looking at GCC as a collective, Saudi is going to be doing the best here. Just when it comes to energy. Now that doesn't factor in the other issues, which is water and food, not directly related to the strait. Obviously, fertilizers. Qatar and Saudi. They have these exports, and India's dependent upon it. So India's losing their gas and fertilizers, but that's a trade from the Middle East that is reliant upon the Strait of Hormuz. I'm not sure what their alternative routes are there. So they're losing a lot of revenue, but then the increase in the price is giving them the opportunity to offset some of those effects. And other GCC countries are being impacted and turning to Saudi that had built much of the infrastructure for this type of emergency.
And so now looking back at the oil prices, you said that there's kind of like parameters between 100 and 115, but surely that can't be for the immediate future or even for the long-term future, right? If the longer the strait stays closed, the higher the price goes. Is that not the case?
Yeah, but I reckon look, this is financial warfare. So if the financial industrial complex wants to employ derivatives to engage in derivative price control, they're doing that. I believe that the financial institutions are going to keep the price between 100 and 115 while it's closed, while the oil companies are negotiating their long-term lock-ins and taking advantage of the situation. I think once you start to go above 110, 115, 120, it becomes counterintuitive to the financial industrial complex, and they'll start getting demand destruction. Once you get demand destruction, you hit a price where everybody's you push the world into a global financial crisis. And so I think the derivatives market will be looking to try and suppress those prices anytime we tick above 110 or so, it seems.
Okay, so you don't think that if the strait remained closed, the price would go above, let's say, 115, 120?
Unless the derivatives market and the financial industrial complex wants it to go above and create a global recession and a global reset, they can. But this is not 100%, supply shock, because the derivative complex is able to manipulate these prices. So the price that you're seeing is the price that the financial industrial complex want you to see.
But what is the derivative market? Like, what do you mean? Well, how are they able to set the price?
Yeah, the derivatives market means that you're able to effectively create paper contracts for oil and future delivery. And so they can use that in order to basically create more paper oil that is never meant to take delivery. But what that does is you can essentially suppress the price by creating a paper synthetic version of oil that needs to be delivered with real oil in the future. And so as those contracts expire, let's say you do a 3 months contract, you need to actually take delivery of that oil, or you need to lock in a loss. And so you can use this in order, if you've got vast capital and you control the derivatives markets, you can use this to take bets, push down the price. But if this goes wrong, it's a dangerous trade. You can end up in what's known as a short squeeze, where you have to cover those positions with real oil. And if the oil doesn't exist, it's what we saw in the silver market. So they can suppress the price. But as you start moving more into these expiry dates and having to cover some of these short positions, you can end up in a short squeeze that can cause some major upward pressure on the prices. So if the financial industrial complex has inside information, then they could use the derivatives to suppress this price. If they think this is going on for a long time, this is years, then obviously their ability to control prices diminishes.
You mentioned to me that if the Strait of Hormuz was to remain closed, we would see basically a Great Depression, maybe akin to, or for example, a financial crisis akin to the 2008 market collapse. Some even profited that the possibility is that this could be as bad as the Great Depression in the past. My question to you is, do you still believe that, the first element of it? And if you do, what's the reason for it? And what about the second element? Like, how bad can this get?
Yeah, I do believe that if the strait remains closed for an extended period of time, but my belief is that there's no option but to get that open, and then Iran has leverage in getting concessions in their favor. So all of this is, again, even the market reactions at the moment, they're not pricing in a global recession or global financial crisis. So if this is an extended time period, then that scenario is somewhat of an inevitability that could only be fixed with massive, ginormous, big print money printing, similar to the COVID situation, would be the only way to be able to combat this. So you could end up in a recessory environment, leading to a big money print, and that breaks a lot of things. Now, in terms of a black swan event like the 2008 financial crisis, if you look at where the stress is at the moment, it's the AI markets and it's the private credit markets. Private credit markets is basically non-bank lending. So, a fund like BlackRock, they would raise a bunch of money from a bunch of high net worth investors and institutions, and they would lend it to, say, software companies that had short-term cash flow needs, or data centers that wanted to borrow money rather than sell shares. There's been a massive spike leading up to this in the private credit market. And unrelated to this, we started to see some real stress in the private credit market. Now, the private credit market, when you're pooling together, so it's mainly, big funds like BlackRock and various others, they started to suspend redemptions, which means that if you own shares in these private credit funds, you want to get cash, you knock on the door of BlackRock and you say, I'd like to sell my shares and get cash. They suspended redemptions because of some of the stress in the private credit market. And that's part of their terms and conditions. And so you're seeing a bit of lawfare, around oil contracts with force majeure, where you say disasters means we don't need to deliver upon this insurance. And then also within the private credit market, you're seeing we're not allowing you to redeem. That creates a real stress in terms of people panicking to want to redeem their shares. And then when you start not being able to liquidate, and they say you can't liquidate, sorry, part of our terms and conditions, people start to try and withdraw from other assets and move towards assets they can control, whether that be gold, whether that be Bitcoin, whether that be cash. And so what we're starting to see as a result of BlackRock doing that, if you look at what triggered the crash of Silicon Valley Bank, it was an oil price shock that led to inflation, that led to the spiking of interest rates. And if you look at the prediction market, the odds of getting a rate decrease rather, which was the Trump stated policy, is going down. And there will be a Fed, you don't expect them to put rates down. But when they didn't put rates down, you had the language around inflation is transitory. And then they had to move to a big spike cycle where, to control inflation, they started putting the interest rates up to try and suppress some of that demand and dampen inflation. And then that broke the Silicon Valley Bank and a bunch of banks, and they had to do a massive bailout. The private credit markets are also suffering from stress because artificial intelligence is disrupting software companies like Salesforce and various other companies. Once those are being disrupted because people are just building technology with AI and they're not subscribing to software as a service, there's massive losses within those private credit funds. They're trying to deregulate American pensions so that they can dump them on the pensioners at the moment as part of a policy. But underlying that is the banks and financials this week have been performing very poorly. And there was some real strange activity in basically interbank lending markets. So you can see that the Federal Reserve has already been doing behind the scenes short-term quantitative easing to bail out banks. Then we had the private credit stress. Now we've had the BlackRock not showing redemptions. If that leads to having to have transitory inflation, a spike, then you could expect stress in the banks, and you could have a complete repeat of that same cycle that we saw during the Russia-Ukraine war.
But how long would it need to remain closed for? Because I remember you mentioned the space that if the Strait remained closed for like another week, you could expect a financial crisis. Do you still think that's the case or not?
I think if this is closed for a month, 2 months, expect a recession that leads to massive money printing and intervention from the Federal Reserve. The Strait needs to be open yesterday, and at the latest at the end of this week. Next week, if we're going through this next week, We'll have another meeting here to talk about all the unintended consequences. And we haven't even touched upon food insecurity, water issues, the war that's led to the targeting of the water plants. That's a humanitarian disaster. And we don't know who's doing that. If we end up this week with water plants, everything suggests that it wasn't what we're seeing. Like, this could either be Israel doing false flags, or we could get a bit more conspiratorial, like we saw with Nord Stream pipeline. Who benefits from this? Russia and America. So do they have covert operations in order to target those fields? Blame it on Iran in order to take the Middle East out of the equation, reset the world order in favor of US and in favor of Russia to Asia, and then open and bring this back. There's all sorts of chess moves here. And then obviously Israel would love nothing more than the whole Middle East to be blown up, and then they have the American backstop. So I believe that it's not actually the Gulf countries or Iran that are actually blowing up these water plants. I'd say it's either Israel or there's some covert operations from US or Russia.
I agree with you, by the way. But in terms of, I think this would be the US making sure that it still remains the global power and weakening anyone who may be stepping out of line. That's a very good possibility. Now, coming back to the situation, I just want to wrap this up by a very important question that I'd say this is probably the main question as to why people have joined this stream, this live, and this TikTok is the average person is panicking. There's mass panic. People are concerned, especially in Europe and the UK, but also in the United States of America, Australia. They don't know what to do. They're, in terms of how they should plan. What advice, obviously, this is not financial advice, but what advice would you give an average person to plan in a situation where the strait remains closed and there could be an avenue towards a global financial crisis?
Yeah, look, while cash is king, you need you need to have three to 6 months of cash flow. That's normal in either your business or you as an individual. Most people are living paycheck to paycheck, so that's the severe stress of the situation. Don't think that you're going to be able to out trade. There will be shocks here, there will be surprised here. If you really want to know what determines the price of oil right now, it's Truth Social. Like, Trump controls the price of oil here. Whatever he tweets out, and the people and the insiders, the insiders would have the inside information and reposition. So only be trading if you can afford to lose it. You're not going to outbeat these markets. It's going to be incredibly unpredictable. Now, you as an individual, you need to take care of your normal cash flow needs. Cash is king in these situations, and that's just the reality. If you are spending less than you earn, then rather than thinking about where do I need to put the markets, where do I need to go, look, the grander thing that we are transitioning to, if you think about it, what is the markets telling us? The strait was closed, Russia aligned with Asia, America aligned with Europe, the world's being split up into parts. As soon as this opens again, you'd expect currencies, dollar to continually weaken again, and other currencies to go back into relative strength. So the long-term thing here is that once this is closed, I'm expecting that foreign capital markets to outperform US capital markets, foreign currencies to outperform US currencies. But while it's closed, you expect a strengthening dollar and a US market to outperform all other markets. And so I personally believe if you are heavily exposed to US, then not financial advice, but just keep your position until it's closed. Once it's closed, ask your financial advisor or your pension fund manager what their foreign exposure look like and whether they're just fully exposed to US. Now, you can't have, if you're in investing position, you can't have enough commodities here. This is a commodities market, global, neutral assets. Now, we've had massive run-ups in price. Don't try and call the top or bottom. You'll get it wrong. is just add your commodity position with anything you have left over, and just regardless of price, dollar cost average, which means whatever the price is, just add some that month, add some that week, whatever your strategy is, and make sure that you've got those, global neutral assets. I'd be buying, into weakness. We got weakness in the Bitcoin market. We've had weakness in the gold market after a massive bump up. But again, you're not, the big price moves have already happened. You've got to be, you will not survive this long term. You need a 5 to 10 year plan where you spend less than you earn and you save the difference in global neutral assets. And if the prices are going down, you're getting cheaper assets. When the prices are going up, your net worth is increasing. There's no short term, there's no alternative. And then you've got to be doing the obvious things around relationships with your community, spending local, making sure what dependencies can you as a community get prices down by bulk buying together. Just really think about this. These are massive global trends, but what is important to you? It's you, your family, your neighbors, your local farmers, your local supply chains. So now is the time to get to know your neighbors, to make sure you're building community bridges. And if you're really thinking about the longer term moves, you need to be going more rural, and thinking about these types of things. They will end up, look, anywhere where you can save energy costs, anything you can do there to make investments in solar or anything like that you can do to start long term planning these things, the better. And there's no alternative to a long-term plan. You need to be, if you're not prepared for this shock, then you need to be preparing for the next shock, because we got the whole AI disruption. We got a lot more to see. Things are going to get more volatile. Things are going to get crazier. And it's really going to be you, your family, and your community just really preparing for these things and not reacting to all the carnage that's going to be thrown at you.
Okay, and what about in terms of the immediate, is the last question, but what about in terms of the immediate, and what I mean by that is like an average person, should they stock up on food, water, oil, gas, anything, or just relax? It's not going to be that bad.
This involves speculation. My personal belief is that this is either going to be a 12-day war or it's going to be slightly extended. That speculation just depends on geopolitics. So keep following what we're doing. Because the moment that opens, oil prices and energy prices are going to crash back down. It's a short-term trade. So I can't say to you, stock up now at these high prices, because if it's resolved next week, then you may have bought all the really expensive stuff. Just know that, these high prices are going to persist while it's closed. And the second it's open, there's going to be the correction. And so there's an element of speculation there, but obviously, if you're non-price sensitive, and you're preparing for absolute disaster, nukes or something like that, then you need all your hard commodities, all your supplies, even though you might be paying more than necessary. But we don't know what's going to happen. It's 100% dependent upon what happens in Iran, what happens with America. And what happens with that, those supply chains from the Strait.
Okay. And there just one final question. I know we're going to end, but just the US now, we did have some news. I posted earlier that the US Navy had struck 3 Iranian oil vessels. Do you think that impacts anything, especially if there's a back and forth or not?
Yeah, I mean, I guess, there's 2 ways to get the Strait open. You either use massive military might from the US and guarantee insurance premiums and force everyone through, and they're able to do that, which I tend to think that they're not, or Iran decides that they're going to open it. China shipments are going through. So this is all, can US use its military might in order to force it open, or will they use diplomacy? And Iran sets its terms on the concessions to make it open. Those are the only 2 possibilities.
Oh no, I meant in the sense of, if the US is now targeting Iranian oil tankers, if Iran starts to respond and target oil tankers in the GCC or various other places, what will that have any kind of impact on, again, what we were speaking about, or none whatsoever? That's priced in.
Yeah, I think right now I think we've set a corridor between 100 and maybe 120. Anything above that, I'd be concerned around why the markets are allowing it to get that far, because that's indicating that they're pushing us for a global reset, global recession. But yeah, I think it's the same thing as what I said before.